Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is David Moore. David is the CEO and co-founder of Equity Advantage. In 1991, he and his brother Tom started Equity Advantage after a successful real estate investment career. David is a nationally recognized expert on 1031 exchanges and a former board member of the Federation of Exchange Accommodators. And in just a minute, we're going to speak with David about how to execute a 1031 exchange. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel, and you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest. David, welcome to CRE PN Radio.
Thank you, Darren. It's good to be here. Thanks for the opportunity to join your show.
Well, I'm grateful you're here, and I'm looking forward to our conversation. Before we get started, if you could take just a minute and share a little bit more with the listeners about your background.
Sure. I typically jokingly say that my brother and I were the original property brothers. We just weren't smart enough to start a TV show. So in 1990, I was minding my own business in California, Santa Cruz, where we grew up. And one of my father's actually patients, he was a dentist, but one of his patients happened to be a very successful real estate investor. And he had started a company called Starker Services that was the largest exchange company in the business during the 80s. And when we had the World Series earthquake, his house went down a mountainside when he was in a board meeting and decided, well, he didn't need to do that anymore. So he sold most of the business and was just working on the investment stuff. And he asked my brother and I, well, what are you guys doing next week? And our response was something that opened the door for him to drag us north to Oregon. And at that point in time, we knew in 1990 we'd missed sort of the turn. Typically, state capitals lag the rest of the state's economy, and we knew the turn had happened in Portland, roughly '88. And so we went and started working in Salem and Olympia and bought some property, and actually down in Eugene area too. And our sort of model was it was a modified flip. And what we'd be doing is we'd buy a property, improve it, get it stabilized, get tenants in there, rent it for a period of time, do a cash out refinance, keep the property for long enough where we would then be able to do another exchange in the short term. And the refi money was typically going to be an amount that would be in excess of what you'd realize after paying taxes if you just flip the property. So I think what happens is people get into the whole flipping thing, and we all know it's a huge business these days. But anything that you're holding for resale is going to be taxed at normal income tax rates and does not qualify for 1031. So using the structure we did, it allowed you to buy the property, do the improvements, take advantage of what you do with a flipper type property. But by keeping the property and seasoning it as an investment, the refi money you get out and allow you to leverage and do what you wanted to without having to pay the tax. And then you take some money and you're not paying yourself, so you're not paying normal income tax on it. And then after holding that property for, let's say, a year, 2 years time, whatever was a comfortable period or whatever allowed us to stabilize the thing, we'd then do an exchange out of that into the next asset or assets. And so what happened is the opportunities were good. We thought we'd be here for a couple of years. And we ended up putting the exchange company together in 91 because nobody was here to do it at that point in time. And the idea was initially, it's just going to give us an opportunity to find more property and, work with more of the professionals in the community up here and really take advantage of more opportunities. But it sort of stole our lives, I guess I should say. And I say that tongue in cheek because it's been a great ride, but something where we thought we'd be here for a couple of years has now been 30 years. So it's funny how life changes. And one of the obvious big changes for me was a year after I moved up here, I ended up finding a girl and getting married. And so that was another anchor for me to the Northwest. So it's funny, you think you're going to live your life in a certain place and things happen and boom, you're somewhere else. So it's been a lot of fun. We've had a great ride. It's been, we've definitely taken our lumps. That last big crash in 07, 08, that was not much fun. But over time, it's been a great business. And we actually put a company, a sister company, IRA Advantage, together in the mid 2000s. And that was very good going into the recessionary period, because that side of the business really sort of blew up during that period of time, with people losing jobs or needing to find that olive branch to the future, whether it was doing what we call rollover business startups to get them into something new using their retirement account, or they just wanted to diversify out of Wall Street into hard assets. And all our accounts through that side of the business allow people to take their retirement funds and go buy real estate or make loans, buy notes, a whole variety of other things too. So it's one of those things where you think you're going one direction, and 20 years, 30 years later, you're in a different place. But it's definitely been a lot of fun, and we've met a lot of wonderful people. So
No, it definitely sounds like an action-packed career there. I'm curious, you mentioned Starker was your kind of entry into real estate in that. Am I correct? Was Starker not the name of the case that
yeah,
started the exchange?
You're definitely correct, Aaron. And TJ Starker was an Oregon company, right? I mean, Crown
Yeah.
Zellerbach and Starker had the case and took it to the highest courts and prevailed. And that was sort of the, obviously 1031 is 100 years old. So a lot of people say, well, Starker's the one that started. No, not at all. But Starker was sort of the framework that allowed this whole industry really to get started. And if you look at historically, an exchange might have been, you've got a property, I've got a property, we're going to each, you want what I have, I want what you have, and we just swap. That's a true swap. That's an exchange, and you don't need an exchange company to do that transaction. But what Starker ended up opening up is you've got a third-party assignment company that can step into a transaction and make things happen. So the final guidelines, or the last major revision, was in 1991, and it was right about the same time that we put the company together, which it just sort of happened to be luck at that time. But yes, you're right. It's the roots of 1031 are on the West Coast, definitely.
And was your
no, he had no relation. Yeah, he had no relation to it, but he knew a good name. And it was funny because he always joked that people would call up and thank you so much for what you've done for it, da 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 da, and they really had nothing to do with the court case, but they knew a good name, and the company's still in existence. It's just not what it used to be, but he's a very smart guy. His name, just if you're curious, is Ron Stash, and he's really just an amazing guy. He taught my brother and I all the basics, mentored us in investments, and it was great because we'd have these 10, 12-hour information downloads to and from. We drive back and forth from Santa Cruz in his little Chrysler minivan, and we go write offers during the day on properties, and at night we'd sort of talk about what we looked at and sort of figure it all out. But yeah, he's a wonderful guy, and he's really interesting because he really put a lot of sort of psychology into transactions and really knew how to make things work. But he looked at things differently. An example I always give of sort of his mindset is that there was an apartment building in the Bay Area that was one of the classic courtyard type apartments. So you've got a pool in the middle of it, and it's just all open around it. And so he always told the story of a building that could not be occupied. They just couldn't get the thing leased up at all. And so somebody came up with the idea, well, let's just make it clothing optional. So now you've got a whole different audience of people in there with nowhere to go, and now suddenly the building's full. And I just think that's sort of, you always look at highest best use. And the other thing he always says, like, look, never buy anything until you can answer three basic questions. What am I going to make? How am I going to make it? When am I going to make it? You can't answer any of those, don't buy the thing. So and I always joke that he would always give us my brother and I, a hard time, because investments outlive their usefulness. I mean, as soon as you get to a certain equity in a property, your return on investment drops to a level you can't afford to keep. So we'd buy a property and we'd answer the questions, we'd put the plan in place, buy the thing, fix it up, get it rented out, the equity's there. And really at that point, you've got two choices. If that equity gets too high, the ROI drops. You either have to cash out, refi, get that leverage where you need it to be, or you do the exchange. And the decision between those two is, have you done everything you can or you need to maximize the value of the asset? And that's where obviously the 1031 stuff comes in. It's just a tool to keep your money yours, and so that's where that got integrated into it. But Tom and I would be happy with an investment. And he'd say, well, what'd you pay for that? What'd you put into it? How long ago was that? What's your rent? What's going on with it? Oh, you can't afford to keep it. And it's like, okay, Ron, you just wrecked another investment. Now we got to shame us into going and doing the next deal. So anyway, but he's just a great guy, and really we're blessed to have him at a very important time in our life. And yep, he's a neat guy. He's still around. I still talk to him. We do a lot of business together even today.
Well, that's awesome, because I think that so often that people do get comfortable. You do something, you get all the work done, and I know even myself, just a little bit of investing that I've done. My first view of investments was, you buy it, and over time the tenants would pay it down, and there wouldn't be any money owed against it, and then I'd be able to keep the rent. That was the limit of my investment thought.
Exactly.
That was where the money was, not in the appreciation and then the roll in actual cash flow, but it was just like debt reduction.
Well, and what you're talking about is a prime example of, if we look at the market today, what are people trying to do? They're trying to get hard assets and tangible assets. And we all hear the ads for gold and silver, or palladium, whatever it might be. But I would say the ultimate tangible assets, real estate. And one of the things Ron always taught us is never bank on appreciation. If you buy gold, you're banking on appreciation, right? And that appreciation might be only inflationary driven, which is the big problem today. But if we look at a piece of property, it doesn't have to go up to make you money, right? I mean, as you just said, somebody else is paying the debt service on it. You're going to end up owning the thing, whether cash flows or not, whether it goes up or not, you're making money on it. And in addition to that debt pay down, you're going to have interest deductions, depreciation, other things going on too that you can always take advantage of. And then the best thing about that real estate investment is that at the end of the day, you're either, as we said, if you flip a property itself for resale, it doesn't fit, you're going to pay normal income tax. But at the end of the day, after you've realized those objectives, you're either going to sell and pay the tax, or you do an exchange and kick that tax liability down the road. So it's just a wonderful opportunity for people. And it's something, if they really look at what's happening in today's world, hard assets, everything's going up. I mean, we've got tax laws that really, if we look at the tax liability on sale of a primary residence today, and you think about that section 121, the universal exclusion, that was put in place in 1997. I don't know what you lived in 1997, what it cost, to buy that thing. But if you look at what $250 or $500 in exclusion meant in 1997 versus $2022, it's an entirely different world. So, one of the issues that comes up in this last year, if I look at my 30 years in this business, unfortunately, every 4 to 6 years, we've got somebody gets elected and they want to get rid of 1031, which, as I said, it's 100 years old. So, the problem is, one of my big worries is always the government getting in the way and changing the rules on stuff. But, you've got to sort of use these things while they're there. And 1031's been there for a long time. We did with Biden's Build Back Better plan, 1031 was once again in the crosshairs. And at this point in time, it's been actually cleared of everything, and it's going to be preserved, and we don't have any caps. But the reason I bring that proposal up is there was, in the initial drafts, they wanted to cap people's annual deferral to $500,000 per person, per year. And that would have been very problematic. I know there are some regions in the country where $500,000 means a lot, but anywhere on the West Coast or most of the blue states, it's not going to do much. And if you look at those numbers, and I think that they were looking at the $500,000 exclusion based upon Section 121, saying, well, hey, on a home sale, you're entitled to $500,000, so we're just going to give you the $500,000 on 1031. And I would argue that the 250 or 500 from 97 probably ought to be $1 million, $1.5 million today. And that would be a much more logical number for 1031 if they were going to do something like that. But anything that stifles market velocity is not ultimately a good thing for even the government with their realized taxes. So, but that's another conversation.
No, but it all kind of ties together here. And I think just to kind of orient this conversation to make sure everybody's on the same page here. The 1031 exchange, if you could just summarize quickly or briefly what it is and then the benefit of it.
Sure. So I look at 1031 as sort of an IRA or 401k for real estate. All right. And what I mean by that is, a traditional IRA or 401k, you're looking at pre-tax money growing tax deferred. A Roth is just tax money growing tax free. If we look at 1031, when you buy a property, your basis in that property is what you paid for it, plus the capital improvements you do to it during the time you own it. So every dollar you put into something, you're either capitalizing or expensing. If you expense it, you write it off. Capitalizing increases the basis. And then furthermore, if it's an income property, if let's say it's a rental property, you're going to have a depreciation that you by law are supposed to take. So it's interesting because, as the world gets more complicated, I think good tax people are one of the most important people for any investor. All right. If you've got investments, you better have good tax people because there's so many things there that you're not going to be aware of. And honestly, even your tax people may or may not be aware of some of this stuff, but you better have good tax people. And we're going to want to talk to those people too during the transaction if we're doing something that's a little aggressive. But you got to understand what the liability is going to be before you ever dispose of anything. And the great thing about 1031 is that you're able to, when you buy something, you improve it, you hold it for a period of time, you now have this increased value there. And the question at that point is, when you realize your objective, do you want to just sell and pay the tax, which is always an option, or would you like to keep the money yours and keep it rolling forward? And 1031 is just the tool that's going to allow you to do that. And I like simple, so always break an exchange into 4 basic components. As far as you're concerned, Darren, you're just going to list a property and sell as you normally would. But before it closes, if you have actual or constructive receipt of the funds, you're going to have a tax liability. So the exchange has to be set up pre-disposition. So typically people ask, well, when do I want to hear about a transaction? I'm going to say, ultimately before you buy the thing, because how you own something is going to mean it's going to drive how you relinquish it in the future, and that's another conversation. But at least when you get the property, a sale pending, at that point you want to be thinking about it. And it's important, for example, if we have a transaction where, let's say you and I own a big building, are we going to own it directly, tenancy in common, or are we going to own it via a limited liability company? Now, each of those things might have an up or down to it. But the reality is that, let's say 5-10 years forward from now, what are the odds that both of us are going to want that asset? And one of the biggest issues, the biggest headache with anything in the 1031 world is time. You've only got 45 days from settlement to ID what you want to buy, and a total of 180 days. Those times both start at settlement of the relinquished property. Now, it's possible to do a reverse exchange where we buy first and sell later. You're still looking at that 180-day timeline. We can do an improvement exchange where we build stuff too. But if we were to own, let's say, this building, and we now go to sell it, we own it as a limited liability company, partnership interests are specifically prohibited from 1031 treatment. So we'd have to drop into what, we would tick it out. And that slang for it in the 1031 industry is we're going to do a drop and swap. So ideally, maybe a year pre-sale, we're going to decide, okay, hey, Darren wants to go left, I want to go right, and we know upon a sale, we want other things. So at that point, if we own it as an LLC, we want to have deed from the LLC to each of us tenancy in common, and we've held it for a year pre-disposition, and now we're free to go do what we want to do on the acquisition side. If we did not do that, and really back to my comment on tax people, don't use your tax person April 14th. Use them before you're in, talk to them before you do anything, before you ever go to sell something, talk to them. But you wouldn't believe how often, even after 100 years of existence, we get a call on a deal the day it's closing, or maybe, unfortunately, the day after it's closed. So you got to plan ahead. Now, as I said earlier, I like simple. So I'm going to break the exchange into 4 pieces. One, it's got to be an exchange. As far as you're concerned, you're going to sell something and buy something. The only thing different is you're going to include a cooperation provision stating your intent to do an exchange. A lot of the state forms have boilerplate in them that allows this to happen. But phase 1 of the exchange, you give us something. Phase 2, we give you something back. Now, when I was talking about a true swap earlier, that's an exchange in the most basic sense, and you don't need us. But using a third-party exchange company, you're literally free to sell whatever you don't want and buy what you do want. It's the exchange company's job to step in the middle of the transaction and turn it into an exchange. So 1, you're going to give us something, we got to give you something back. 2, what's given received have to be of like kind. The like kind definition, and I joke about this, that 30 years ago I had a lot more hair on my head, but in those days people say, well, I remember when it meant a house for a house, land for land. It's never meant that. Okay, like kind in 1031 context is nature rather than form. So any real property held for investment is going to be like kind with any real property acquired with the intent to hold for investment. Now, in 2017, we used to do lots of personal property transactions, and most of those, honestly, were high-end cars. And one of my favorite transactions was we exchanged a 1957 Fiat Rappi, I think it was. It was like a $3.5 million Fiat, believe it or not. So we exchanged a Fiat for, I think, 2 Ferraris and a Maserati. So when do you think that would ever happen, right? But that was a situation where it was a great investment. It happened. We had somebody work with a McLaren F1, which I don't know if you're a car guy, but McLarens were the McLaren F1. Adrian Newey designed. I mean, it's the most amazing road car ever built from my perspective. And we had a guy make $4 million on one of those in 2 years. So in 2017, we lost personal property transactions. We used to do lots of aircraft and planes, planes, helicopters, even fishing boats, stuff like that, artwork. But it was sort of victim to the 1%er stuff. The personal property transactions went away, and honestly, we lost personal property. Ended up with the opportunity zone. The OZ is sort of its replacement. So I'm not a real fan of the OZ because I think that's the reason we lost personal property. But I understand why things were going on. The OZ is there to stimulate development in areas that need development, and I think it's a great tool for people that are selling other things other than real estate to get it into real estate. But I just sort of sidetracked into that whole conversation. But one, it's got to be an exchange. 2, it's going to receive your like kind, and so that personal property stuff's all gone now. And so real property you can exchange from dirt into office buildings, into strip mall places beach retire into. All those things are going to be of like kind. So I want to mention too, back to my comment on 1997 on Section 121, the universal exclusion. Before that, it was 1034 if you were 55 or older, you had a one-time lifetime exclusion on gain on the sale of a primary residence, and that was 125,000, and that was it. It was a one-time deal. But the great thing about it was if you sold a home, you had 2 years to buy a new home of equal or greater value. If you did that, you'd be totally tax deferred. Now, you think about the world today, Section 121 says an individual's got $250,000 excluded gain on the sale of a primary residence they've lived in for 2 out of the preceding 5 years. Married couple gets $500,000. So in 1997, like I said, those numbers meant a lot. And in today's world, they don't. So the reason I bring this up is it's possible to convert a primary residence into an investment property, and it's possible to convert an investment property into a primary residence, and there's reasons to do both of those things. And we have lots of people that do that. And we'll, on the retirement side of the business, even we'll have people go out and acquire a property in Florida, maybe they want to retire into, and we can do that also with retirement money if somebody wants to do that. Now, it's another conversation we'll have another day, but it's important for people to know this stuff. And I think one of the most fun aspects of what I do over the last 30 years is that so often people think there's black and white answers. You can or you can't do these things. And rarely is that the case with tax law. It's more often the case of how we're going to get it done. So it's really a lot of fun when we're sitting there looking at a process or looking at somebody's objective and finding a solution that says, well, gee, I didn't know I could do that. I thought I was going to be stuck with this or that or whatever it might be. But if we could sort of, I call them little nuggets of knowledge, right? We give people the opportunity. So that like-kind thing is one of the big misunderstandings in 1031, because people think I got to go house for house, land for land. And it's never been that way. So the third of my sort of 4 cornerstones is what we call the Napkin Test. And that just says that for total deferral, and I want to stress 1031 is not all or nothing, but to be totally deferred, you need to go across or up in value and equity between the relinquished and the replacement property. And the value and equity numbers are net of closing costs. Finally, we've got to have continuity vesting, and that means the person or entity that gave us something has to be given something back. So that example I gave of the 2 of us owning a building, if we own that building as a limited liability company, the entity can go forward into whatever we want. That's fine. But if we sold as an LLC and you wanted to go left and I wanted to go right, we could not do that because the partnership interest is specifically prohibited. Now, as I said, the biggest problem with any exchange is time, that 45-180. The second biggest issue is vesting, because think about, I'm sitting here in Portland. We're both in Oregon. Oregon's not a community property state. So if we look at even spouses, imagine this, the number of clients I have that will start off, most people's first investment is their home, right? And then they, get married or have a kid or get a dog or whatever, and the house is not big enough. So they end up either selling the house or they move out of the house, keep the thing as an investment property and go buy the next property. So, when we're looking at people's ability, so that's a conversion from residence into investment, and that's totally fine, as I said, and we can go forward and switch the thing back the other way. But if we look at somebody that start with one investment property, then they get another investment property, then they get another, then their lawyer says, gee, now you've got 3, 4, 5, 10 different investment properties, you've got a fair amount of liability there, so let's shove them into a limited liability company. Great, fine, that works. That gives you some protection. Now let's fast forward a couple of years. So you've gone through your investment plan. It's now time to relinquish that property that's owned by the limited liability company. You want to go forward into a new property. If the property is 4 units or less, what's it financed as? It's financed as a residential loan. And if we try to finance the LLC versus the spouses, the money's going to be more expensive. Okay? A lot of people say, well, you can't finance an LLC. That's totally wrong. It's just going to be more expensive money typically. So suddenly I get the call because our clients who have an exchange set up as a limited liability company are now upset because the cost of money for the acquisition is more. And since they live in Oregon, I cannot give them the new property personally. They have to take ownership via the limited liability company. Now, if we go to Washington or California, we can have a husband and wife give us a property in LLC and take ownership of the new property personally, and that's going to be fine. But that shows you how easy or how easily that whole continuity vesting issue gets to be a problem. So I just gave you 2 scenarios where it's problematic.
Yeah, no, I didn't realize that the states vary on their vesting rules. Is that what I understood you to
Well, it's
say?
just whether a state's community property state or non-community property
Oh,
state.
okay.
That's going to dictate what happens with the vesting, to your point. That's going to dictate how we can move forward in the exchange.
Gotcha. Gotcha. Uh, I'm fascinated. I mean, just all the things you were talking about there. I was curious, pre 97, when personal property was still in play, what percentage of your 1031 business was personal property as opposed to real property?
At the top, maybe it was about 20%. I mean, it was the car side of it was probably the one that was growing the most, just because, I mean, and you can see the results of that right now. I mean, you think about the cost of a car today and what's happening. And I think that was just a precursor, because I think anytime we've got bumps in the road in the economic world, people are looking for hard assets, right? And so, I mean, sure, you go buy a painting, you hang it on the wall, but I mean, an investment car you get to play with the whole time, you get to use it, and the thing's going crazy in value. And you can see, I mean, if you look at any of those auction houses, you know what they're doing, and whether it's the Japanese cars are hot right now because the other stuff's gone up so much, but everything's sort of coming in play, and you can look at any segment of that collector car world and see what's happening very easily right now, and it's a different place. So that's what really impacted things there. Obviously, if we're talking about aircraft, well, the other thing is, like, for example, Hillsborough Helicopters here in town, that they are the largest, or they used to be the largest Bell helicopter dealer in the country. And so you think, typically, if we're talking about aircraft, the gain is not, and everybody out here understand that the gain has nothing to do with profit, right? Gain is simply a tax calculation. So it's your basis subtracted from the sales price. So does an asset have to go up in value to trigger tax consequences? And the answer is no. Depreciation is going to trigger tremendous gains in certain circumstances. And if we look at an economic collapse, we might have a situation where you think you might lose a property foreclosure or a short sale, and you're thinking, well, not only did I not make any profit on this thing, but I lost everything in it. Well, if you lose a primary residence foreclosure or short sale, you've got some tax relief that's there. On income properties, you do not. So you've got to understand that if we have a short sale or foreclosure, the sales price is not, quote unquote, the sales price in the government's eyes. The debt on the property, whatever's greater, sales price of the debt could be considered the sales price. So if you've got a debt over basis situation, you've got what's called phantom gain, and you just lost an asset, lost all your equity in it, and you get hit with a tax on top of that. So that's one of those things where people get confused, because they don't, well, I didn't make anything, I lost everything. No, gain has nothing to do with profit. So it's merely a tax calculation. And the reason I bring that up is personal property stuff. You asked about what percentage of the business was personal property. We used to do a lot of heavy equipment too. So you say, okay, heavy equipment doesn't go up or down in value. Typically it's going down in value, but the depreciation on that stuff's going to trigger a gain even on a dramatic decrease in value. When we're looking at the comment I was making on Hillsborough Aviation, if you look at a lot of those helicopters in the heyday, the helicopters, the weight to buy one, and you can see that even with watches today, a new watch is cheaper than a used watch, because the new watch you can't get, right? So, and we had that same scenario going on with aircraft. So it's really interesting looking at these different things, and you might not have an increase in value. It's just a decrease, but it's a depreciation driven gain rather than appreciation driven gain. And by the way, the government's position on depreciation is you should have, therefore you did. So you could be a person that said, well, I don't want to take depreciation on it, and therefore I'm not going to be liable on recapture on disposition. The government doesn't care. You could have not gotten the benefit of depreciation and still pay for the tax on something you didn't get the benefit of.
Yeah, I get that. I mean, totally. The whole idea at least the beyond the reduction of the principal, which was my original idea on investment. Once I recognized the depreciation, I was like, holy moly, that's really where, I mean, that to me was the secret of real estate.
Oh, definitely. And I
Yeah.
mean, and to further exemplify that, once again, back to my comment on who is actually, doing your tax work. If you could just go buy a simple rental house, who makes the allocation dirt to improvements, and what happens to your return on investment if you jack up the value of the improvements or decrease the value of the improvements, right? So the more the improvements are worth, and that's the most basic form of cost seg, is just dirt to improvements, right? But if you
Right.
jack up the value of the improvements, you got more depreciation, your return's going to be better. If you look at a commercial building, you're going to be looking at a situation where you've got cost segregation studies done, and we were both at that event I don't know what, a month ago with Aldrich, and it was a great event. And but the cost seg is one of those big issues there that's sort of going to manufacture return, let's say. But
Yeah. It's, and again, the kind of as the investment lessons go, the longer I invest, the more I find that the need for 1031 exchange exists, and the understanding and then actually utilizing one. I'm curious, in your experience, you mentioned like when you guys first got started, how you would improve a property, refinance, and then recognize that you couldn't afford to keep the property, you rolled into another property. Is there an average um, hold time that you find that your customers will hold a property before they'll take advantage of an exchange, or maybe if they don't hold it very long, if it's newer, that they would elect to just go ahead and pay the tax?
well, I mean, typically you're probably ideally looking at 3 to 5 years. I mean, unless we have some abnormal event going on out there that's going to change things. And the thing that sort of you look at our market today, and you do this show regularly, but you think about cycles, on economic cycles, and how many years typically between some type of bump in the road, right? And if you look at our current situation, we've been pretty much going up since what, 08, 09. I mean, you think about people's typical hold. Now there are institutional investors that have held assets that normally would hold maybe 5 to 7 years. If you look at Delaware Statutory Trust, for example, or institutional tenancy in common. So DST's Delaware Statutory Trust, it's typically a fractional passive ownership in a pool of assets. TICs are typically a value add situation. They're not stabilized assets, DSTs typically are, but you're normally looking maybe a 5 to 7 year hold in the institutional world. Most of our clients, probably they're more hands-on, doing seven is probably 3 to 5 years. But I would say there's lots of institutional assets out there that have, instead of the 5 to 7 they might normally have, are sitting here looking at assets they normally have a 5 to 7 year hold on, and it's now been a dozen years and they're still sitting here. So, and if you drive around like office buildings, you've got a bunch of shadow inventory. They might publish a number, say, well, gee, we've got 80% occupancy, but drive by them at night. You see how many are lit up, what percentage of a building's lit. And so it's very interesting at this point in time to see where we are, people's attitude about it. And when we have changes in the economy, typically if Wall Street, people are concerned about Wall Street, our IRA business, IRA 401k business increases because people are looking at hard assets once again. And what's interesting to me, in the last 6 months, that side of the business is definitely increasing. So I'm seeing concern from that side. Meanwhile, the real estate world sort of like, well, this is just going to keep going. I don't know. There's lots of people out there that are a lot smarter than I am, but I don't know how long we can keep going the way we are. So.
Yeah, I find it interesting how, the cycles, when you map them out on a chart or whatever, they, you can see them on a regular basis kind of thing. But like you said, in the situation we're in now, where how much of it is natural versus how much of it has been altered based on, the printing of money, just the change in the situation based on how COVID has changed, things so much based on people's desire to live wherever, as opposed to just where their job is, or live in a house versus in a, more of a concentrated, unit structure, or retail, or like the office, like you mentioned, how many spaces are actually occupied versus not. I mean, there's just a lot in play that I don't think that, had you looked at this cycle from the end of the last cycle, so say 2008, I think most people would have thought we would have been through another major dip by now.
Yeah.
And so, but based on all the demand and in the hot, or the asset classes that are the most hot, I mean, the multifamily and industrial seem to be, there's just not enough supply. Will it be a across the board crash, or will it be a segment crash? And what's not to say that what we went through with at the front end of COVID wasn't that dip that, the market was looking for, or, the cycle was looking for. I don't know.
Definitely. Well, I think, I mean, historically you have Wall Street crash or real estate crash, right?
Right.
And then that 07, 08 thing, Wall Street crash and took real estate with it. And from my perspective, it was just a question of available funds, right? I mean, if you don't have the ability to move an asset, you're not going to move it. And one of the sort of objections that Wall Street has with respect to self-directing a retirement account put in real estate is that they'll say, well, gee, real estate's not a liquid asset. So what happens when you hit, in today's world, 72, and you've got to take required minimum distribution, RMD? And if you don't have any money there, how do you take the RMD? Well, we've got an easy solution. Just take an in-kind distribution. So you just take a piece of an asset or pieces of shares, membership interest in LLC. Could be done too. And there's benefits to that also. But in general, you're right. You don't want to stock, you sell it, right? If you don't want a piece of real estate, you got to put it on the market. And we had, some huge unfortunate examples in our region during that crash, where you had very large institutional investment companies that just went away. And that's what sort of led us into that whole phantom gain issue that I mentioned earlier, where you had an institutional investor and it was a passive investment for the taxpayer, and then the thing goes belly up and now they got nowhere to go. But if we look at, so the question is, right now, if we have a meltdown in Wall Street, let's say, does it destroy our ability to move assets in the real estate world? And if the money's available, then we're going to be just fine with whatever happens there. If the money's not available, then you've got obvious tremendous erosion in values. And unfortunately today, I would say that a lot of people's gains are not, they're not based upon a true increase in value. It's inflationary driven, right? I mean, you look at what, I joked with my wife about Christmas time this year. I went to one of the real nice butcher shops here locally and walked back in the house with several $100s worth of beef, right? And I'm thinking, okay, that should be $30 worth, not $200 worth. But so it's a different thing, and so unfortunately the exclusions, let's say on the sale of primary residence, they just don't cover things like they did, and obviously the laws need to change, but nobody's really interested in doing those things. So that's what leads us to my comment earlier about people assume there's black and white answers to things. If you take a home that you've got a gain of $1 million on, and you're married, well, you get $500,000 of it covered. The other half you're going to have exposure on. Does that mean you're going to actually have to be stuck paying that? And the answer is no. Move out of the house. Treat it as an investment property for a period of time. People want to say, well, there's a set period of time. Well, the code says 2 years. You got to hold it 2 years to qualify for 1031. That's not true. 1031 doesn't contain any hard hold requirement. Now, if you and I were brothers and we swap properties, we've got a 2-year hold in that scenario. But if it's an arm's length transaction, it really has to do with intent and what's going on. You mentioned COVID earlier. So imagine if you bought a property just pre-COVID, you closed on it in March of 2020, let's say, and now all of a sudden, wham, COVID hits. And your tenants, in Oregon, our governor said, well, gee, the tenants don't have to pay, right? So now you're sitting there having to pay the debt service. You can't afford to pay it. You bought it. You thought it was going to be fine. Could you sell that property a month, 2 months after you bought it? And in that scenario, I'd say yes. Yeah. Because your intent was to hold it. Circumstances dictate a different course of action. So that's what makes me uneasy these days, is when we look at things that we don't have control of, and the government getting involved with things where they're just changing the rules with on us overnight.
Yeah, definitely some interesting political stuff, and hopefully we're through with the shutdowns and we can at least go forward without any more of the overreach there. But time will tell here. Hey, David, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And when that's not an option, then we look to see if there's a way to transfer the risk. And that's what an insurance policy is. And I like to ask my guests if they can look at their own situation, and it could be their clients, the market, interest rates, political, however you choose to frame the question, and ask you, what is the biggest risk? And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. But if you're willing, I'd like to ask you, David Moore, what is the biggest risk?
The biggest risk for an investor on assets, or the biggest risk in an exchange, or what in what?
Yeah, I'll let you frame it how you see what is the biggest risk. Could be either or.
So I think my biggest concern right now is just government changing the rules on my clients, in the middle of a transaction or after somebody's purchased something. And I just see so many situations today where you have to look at somebody's intent and what they're trying to accomplish versus what the laws are actually they're allowing them to do versus what those laws were actually intended to do. Now, if I look at just complexity, and I'll just say as far as insurance products, I'm not a huge fan of limited liability companies for holding property. And if you look at what was proposed in Biden's Build Back Better, you rarely ever see an asset held by a corporation these days, because if you and I own an asset in a C Corp or S Corp, we just want to go different directions. Just taking the asset out of the corporation is going to trigger taxes that nullify any benefit of an exchange. You're stuck in that entity. They want to go market to market on distributions from limited liability companies too. And we talked about community versus non-community property states, even with spouses with LLCs. I've got clients that'll have a single LLC for all their properties. I've got clients that'll have an LLC for each property. I've got clients that don't use any LLCs. I would say a good stout insurance policy I'm a bigger fan of than the LLCs, because of the complexity of moving assets with the LLCs. Now, as I said, if we're in a community property state, an LLC is a lot easier to work with than it is where we live. So, that's one of my concerns. But my biggest concern right now is just the government changing the rules on stuff. And an example of that would be, here we've got the city of Portland that wants more housing. And you can argue whether you think VRBO is housing or not. Obviously people have sort of shifted, instead of long-term rentals and renting to people directly, they're going to use that mechanism so they don't have to deal with some of the rent control laws. So, the Multnomah County changes the rule. It says, okay, so we've got a number of clients with retirement accounts, self-directed IRAs, 401k plans that buy rental houses, and they were using VRBO for that thing, and it worked very well. So they've got these assets, that's property that's available. And all of a sudden the city, county, state, somebody makes the law change. So no, boom, now you can't own these things. You can't VRBO unless it's owner occupied property. So now every client I've got that had properties used that way with a retirement account, by law, they can't occupy or use that property anyway. So that no longer fits. So everybody that had those things now has to sell them and go do something else. So it's tough when we've got bureaucrats out there changing laws on things they don't understand at all, and they change the rules. And this whole rent thing, that vacation from rent, I'm sorry to sound callous on it, but nobody's giving the landlord, that property owner, a vacation from paying the debt service, and everybody assumes that landlord is a wealthy person. And I will be the first to tell you, I've got so many clients. They are land rich, cash poor. Everything they've got in that stuff, they've worked their tails off throughout their lives to accumulate some pool of real estate, and they're not wealthy people. They need that. That's what they live off of, and they're good people. And the other thing I'm seeing a fundamental shift in is with the rent control laws and the changes in what property owners are able to do, you're seeing a lot of those people put up the white flag, and they're exchanging out of these assets they can no longer afford to deal with and into these passive investments, the DSTs, the TICs, that type of stuff. Now, what the government people don't understand, I would say, is that mom and pop that owned the property, they cared about the tenants. They knew the tenants. They really, it was a different situation for them. They cared. And by the way, that $4,300 move out charge, if you don't do it correctly, that hurts the mom and pop. Well, what do you think a REIT, a real estate investment trust? I'm seeing a fundamental shift in the ownership of our local property, going from local people to institutional ownership from somewhere else. They don't care. It's a different deal. So it's just, there's lots of things happening out there, and I think it's all calculated. And so my concerns are just rules changing on people with really no thought from the government of the true repercussions of those changes. And I see firsthand how it impacts my clients. And it's not good. So that's what really bothers me most. As far as the insurance, the liability stuff, the LLCs, like I said, a good insurance policy is going to take care of that. The other thing that is always out there too is with, for my businesses, we're moving money all the time. So we're concerned with all the wire fraud stuff. I mean, that's a huge thing. So having the policies, the insurance policies in place that are going to protect us, because, the business owner's got a lot of responsibility, let's say, out there, and liability if it's not taken care of correctly. So that's something, unfortunately, is just out there and seems to be growing and growing. And I really don't understand how they can't put a stop to that with a flip of a switch. Anything that's wired has to be received by somebody. I mean, you just lock down that money for 48 hours or something, don't allow it out. And I would think that would change that whole thing a lot, but nobody seems to be looking at solutions like that.
Yep. Nobody asked you or me.
Yeah.
I get it. I get it. I like both of those. I think the government changes in the rules is definitely a concern, I think, across the board for everybody. And I think that most people that I deal with, they just want to know what the rules are so they can go forward, not always be in like a sense of limbo, like, what do we got to do? What are we going to do? And then that cyber stuff, the fraud thing, that's just scary because it's just so far reaching, and it's everywhere. So good stuff.
But it just seems to get worse. And I mean, just change the laws with respect to wire transfers and holding. And I mean, I always think about when we do different transactions, we're doing an improvement exchange or reverse. Sometimes we're doing different bank accounts, or we do something somewhere else. What you have to give the bank to open a bank account today, right? You think, okay, that in and of itself should be stopping some of that cyber fraud, just because to get the account itself, you practically have to give them your firstborn, and you think, okay, well, you've got this account, somebody had to put that information forward, and whoever put that account together, that money's going in or out of that account, lock it up. So.
Yeah. No, I hear you. Well, David, I can't say thanks enough for taking the time to do this today. Before we shut this down, where can listeners go to connect or learn more?
Well, I think that probably they say YouTube's sort of the ultimate search engine these days. So if you want to learn more about what we do, 1031s, all different aspects of the process, and actually we've worked hard to have information on our YouTube channel. So you just type in Equity Advantage 1031 on YouTube or IRA Advantage self-directed retirement accounts on YouTube, and our pages will come up. And there's videos on everything from life policy sales or investments, charitable remainder trust, cost seg, DSTs, ticks, all kinds of different aspects. It's not just us talking about why you should use Equity Advantage for an exchange. Our channels are all up there for informational purposes. A lot of the information doesn't even have anything to do with 1031. We just want our clients to be informed and understand what's possible out there, because so often they're told you can't do this or you can do this, and both of those answers can be totally wrong. So, as I said earlier, I like to just break it down to those four basic elements. If it's an exchange, it's got to be an exchange. Like kind's got to be satisfied across or up in value and equity, and then investing and in retirement accounts, it's really even more basic. I mean, you're just looking at what the person wants to invest in and who are they transacting between for the benefit of. And those two things are going to dictate whether you can or can't do something. So I like, as I said earlier, simple. So we try to get the information out in a format that's going to allow people to understand it instead of getting into the weeds with the legalese of it. But I like to say there's absolutely no such thing as a dumb question, right? So you got a question, reach out. 1031exchange.com is our URL, and you just reach out anytime with questions you may have. Even if you're working with someone else, we'll do what we can to help you out. So
Awesome. Well, David, I can't say thanks enough. It's been a real pleasure speaking with you today. I've learned a lot, and look forward to doing it again soon.
yeah, I enjoy it. Thank you very much for the opportunity, Darren, and Happy New Year to you and everybody out there. And look forward to working with you going forward.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.